Hello, hello, hello. Good morning, folks. This is Jackie P, and I'm with Julian. Hello, say hello to the people, Julian.
Good morning. Hello, everyone. Thanks for joining us. Today, we got a couple things to tackle, just sort of a variety of topics based on what's going on in the world. Tariffs, Fed rate cuts, TCJA, which we've spoken about before, but continues to be timely. Jackie, what do you got?
Yeah, I think there's just a lot of things happening, a lot of moving parts. Well, I guess there are always a lot of moving parts, but in times of old, right, usually there was just like one main player, right? It might have been inflation, right? And that really dictated what people were thinking about the market. But now we have tariffs, we have potentially the tax cuts. So let's cut into it. So let's cut into it. Pun intended or not, we'll find out. So let's talk about the Fed's next move. You know, there's been a lot of back and forth between Jerome Powell and our president about the interest rates. Julian, what do you see people or what are investors pricing in currently right now? What are the current expectations?
It's a great question and something that, with tariffs going on, is somewhat taking a back seat. Is essentially the rate cuts and dynamic going on. Right now, Fed funds rates in around four and a quarter, four and a half, essentially unchanged since 2023, right? It's been about the same level for a little bit of time. Still pricing in one to two, maybe three rate cuts this year, but the uncertainty around tariffs definitely creates some hesitancy for the Fed, right? Because tariffs can create inflation because there's not enough goods because we're almost artificially restricting them from coming in. And whether you agree with that or not is a different story. But the nuance around it, it's almost like Jerome Powell doesn't want to pull the trigger yet because the outcome of the tariffs is very much unknown, whether it's going to be positive, negative, or neutral. What would you add to that?
Yeah, I think the Fed has always been in a way uncertain themselves, right? It's almost comedic at this point how every year they come out with that dot plot and they say, "Hey, we expect X amount of cuts or raises this year." And I don't know, check my facts here, but I don't know if they're ever consistently even within margin of what they say they're gonna do. So with the added tariffs, it's just an exponential amount of uncertainty because yeah, we don't know, one day there's 140% tariffs, the next day there's 70, and then it's paused. So it's hard to make a decision for anyone with that type of back and forth.
Exactly. I did misspeak. So they peaked in summer of 2023 rates, but going forward, they've been coming down since. But yes, it's certainly a nuanced component as far as what's next and where we're at. Unemployment remains low, and so we're just waiting to see data dependent Fed, right? As far as what they choose to do next. So there's a lot of nuance to it. But as it does come down, can be good for refinancing mortgages if you happen to buy a home with 6.5% rate or something along those lines. A lot of different opportunities ahead as they evaluate that.
Yeah. And before we switch to the next point, I would say what the folks on Wall Street are expecting are one to two cuts by the end of the year. And I use the word hoping because that's what it always is. They're hoping that cut comes in July. But then again, we still don't know, right? It's always funny with the media how they portray, they look at what Jerome Powell is saying or how he's holding his papers and try to make these predictions on if there's a cut coming. But I'm not a big predictor here, but I don't know if there's going to be one. I think, he's very conservative with throwing interest rate cuts out so quickly. So, but I could be wrong. I've been wrong many times before.
Well, the risk is really that they cut now, even if you feel like they should, which I feel like they should, but different story. They cut now, and then the tariffs lead to decreased supply in the U.S. of goods, and then inflation picks back up again, and they already used a lot of their ammunition or too early, right? Because when you look at the ports of Seattle, LA, essentially things are slowing down pretty significantly. because of the lag time between the start of the tariffs and where we're at now. And so we won't see or feel the result until maybe the end of May, early June, and see the lack of goods that we have based on the tariffs that have come into play. So him cutting now, he essentially said, well, of course, they're always data dependent, but it might be too early to do that because if inflation ticks back up after they cut rates, that would be a significant challenge that they would make harder for themselves.
Julian, I feel like I know the answer here, but do you think with the expected cut in interest rates, should this impact someone's fixed income strategy? Should someone be doing something or not with these expected changes?
It's a great question. It's hard to nail down. Your portfolio is very personal. It should be personal to you based on your timelines and overall risk tolerance. When you look at short-term cash, we do look at money markets and not necessarily speculating based on rates. Because if inflation ticks back up, that is going to be unexpected for you if you were to hold long-term bonds and take a hit there, right? Because if rates go up, bonds typically go down. But I would say you want to match the maturity of your bond to your goal if it's short term. And if it's long term, your portfolio should be market agnostic, where you're very diversified, very rules based strategy, because you're more likely to get burned. And even the guys in with all the supercomputers and all the data in the world, one tweet, we're in a scenario where one tweet can very much change the entire dynamic, right? Trump could come out next week and fire Jerome Powell. So even if you're right, one bad morning, one bad night of sleep, and things can change very, very quickly.
Great point. All right. So next thing, let's talk about the tariffs and the trade tension and what this means for the markets. We had a lot of bit of volatility early in April, and it seemed to have calmed down. Now things are seem to be leveling off, but we don't really know for sure. So what do you see the tariffs, I guess, long term impacting? And do you think they're going to stick? I think a lot of folks are still holding on to the fact like, hey, Trump is posturing and this is how he does deals. But just opinion, do you think he is, or do you think he's really gonna he's trying to make like that big change and keep those tariffs high? What's your hot take?
Well, he certainly has a strategy. It's just about how often that strategy changes. I think we can all feel that, right? And you may agree with the overall goal of setting a level playing field, which I think most people would fall behind. But the rash way of going about it can certainly create some tension and questions. When we look at it today, right, they're expected to announce an agreement, partial agreement with the UK. So maybe that's the first domino to fall that gets the others in line. Not sure how fleshed out it'll be, whether it'll be 50% or 60%. I wouldn't expect it to be 100% fleshed out because there's so much complexity around these things. And even when you look at the UK in the past, when there was Brexit, they didn't want to give the US pharmaceutical sector full access to their consumers, right? So when you look at it, as much as we want a level playing field, they also don't want to create hardship for their economy and their citizens. So a lot of nuance to it, something we want to keep an eye on. But hopefully it's first domino of many. What would you add to that?
Yeah, I just think that this is just going to lead to a more, I'd say, global economy that might just be beneficial to those who are more geographically diversified. Um, as everyone knows, S&P 500 has been the rock star for the last decade plus. Um, and if these tariffs stick, to whatever degree, we are going to see a shift on the global market and how trade is done. And We kind of saw a glimpse of it back in 2018, when there was a little tariff battle with China, and we saw correction there. But we've already seen not just China, but a lot of other countries that are trade partners with the United States start making moves that protects them as well, from a trade perspective. So we might see that real, I guess, in my opinion, I don't think the S&P 500 is not going to be a place to invest. A lot of people are saying that. I think a lot of people are getting for clicks saying, hey, S&P 500 is dead. I don't think that at all. But I do think there is going to be more global opportunity, at least from an investment perspective in the capital markets.
Yeah, and how's international done year to date? Do you have those numbers in front of you?
Last time I checked, which was yesterday, it was up like just under 10% or in that ballpark. And we've seen this before, right? They say at the, you know, two, 2000, 2010 was a decade of no returns. And that only meant for folks that were only invested in the US stock market. Individuals that were invested globally, more internationally, did see returns during that time period. But historically, when the S&P 500 has low or no returns, international tends to outperform and be a good ballast. So right now it's outperforming. We don't know how long that will stick, but if things continue down this path, we just might see that opportunity, that shift still be in place.
Exactly. And the depreciating dollar is certainly beneficial to those international earnings. Whereas in the past, we've seen over the past couple of years a lot of appreciation in the dollar, which means the value of what US companies sell to other countries is effectively lower, right? Because their currency is worth less. So right now, that depreciation has led to a lot of that positive performance, which is great. And if you have been diversified, you've been seeing the benefits where you're positive for the year. If you're remotely diversified, as our families are, and thus, as opposed to being down, 5, 6, 7% year to date. So it's certainly been beneficial.
Yeah.
Next piece, anything you would add before I jump to the next one?
No, I was just going to complain that the dollar weakening is not good. We have a lot of families traveling internationally for vacation, so you still will feel it in the wallet at some point. But yeah,
Yeah.
next spot. Yeah.
Yes. If you're in the position to travel, awesome. And most families sort of are, but yeah, you'll have to take the hit there. But you do benefit in your equity portfolio. It's similar to when inflation ticks up. Folks say, "Oh, I can't believe I'm paying more for Tide at the grocery store." Totally fair. It's inconvenient. But if you look to your left, your investment portfolio has been keeping up with that inflation because you own Clorox, you own Procter and Gamble, right? You own all these companies and products and benefit from those price increases. So look to your left and you'll see your portfolio performing very well. Look to your right, you pay an extra couple bucks for Tide. Sorry. Next topic, 2025 tax sunset prep. So set the stage. We've talked about it a bunch of times. Tax Cuts and Jobs Act set to expire at the end of the year. What can folks be doing? Of course, it is dependent. They may change. The executive branch, in conjunction with Congress, may roll out a new bill, effectively, no tax on tips, all sorts of things, changing the tax rates. But as of right now, that has not happened. And so, what should we be considering? Give us some quick bullet points on what we are looking at for next year.
Yeah. Good point. So high level tax rates, tax brackets are going to rise, right? We're going to reset back to those pre-2018 tax brackets. So for a lot of people, right, depending on what your income is and your personal picture, some folks might want to take advantage of their lower tax bracket, right? So that might be Roth conversions, taking advantage of perhaps maybe realizing gains if there's something you've been holding, investments or concentrated stock you've been holding for a long time. Also, I'd say the biggest thing is the estate tax exemption, which is currently somewhere between like 13.5 million, right? It ticks up with inflation every year. Might be a little bit higher for 2025, but it'll be basically cut in half, down to between 6 or 7 million. So if you are in that world, I would take advantage of that estate tax exemption. because it is grandfathered in. So if you took advantage of your full 13 million estate tax exemption this year in 2025, and it lowers to 7 million, it doesn't matter, right? It's not like looking back. Um, but yeah, it's anything like that, strategic gifting, right? Just really, really take advantage of it. Now, I would say again, I say I'm not a forecaster, but I've been forecasting a lot on this one here. But I don't know, Julian, what do you think? Do you even I don't think I don't think they're gonna let it sunset. I think, Trump is very lenient on the taxes, right, for high income earners. And w- is there a possibility? What are the odds that they're gonna let it sunset? What would you say?
I don't know if you can properly handicap it because how much capital is the administration using up? And I say relationship capital and essentially in negotiations with Democrats in the and we don't have to get into it, but in the deportations and the tariffs, right? They are using so much capital up in these other places that it's really about where the Democrats dig in. Um, but it's definitely something where if you have a good idea of what the future likes, which in what looks like, which in our view, as of right now, it will sunset until it officially won't. Then you want to take advantage of the moves you can make, and it's very rare that you would make such a substantial move that still wouldn't be beneficial in the long term. A lot of times these things just get the ball rolling, and they're positive moves in different tax structures and different tax administration. So something important to note, and this obviously relates to a small group of people, but if you are going to gift up to the estate tax limit, let's say it's rough numbers. Right now it's 14 million, it's going to go down to 7. If you only give 3, you still only have 7, right? If it comes down. So you have to completely fill up the cup to take advantage of it if it decreases, right? It's a little bit hard to describe, and it obviously correlates to a lot less families, but you have to use the full exclusion in order to take advantage of it for 2025 prior to 2026. So something to think about, but for the most part, tax rate's going to go up. Be proactive. And rarely, rarely, rarely is it a negative to be proactive in this regard.
And I'll use this time to be compliant and say this isn't tax advice. Make sure you're working with a certified financial planner and a CPA and a state attorney to make sure you're not also making uh, anything that'll put you in a worse position down the line. So, but yeah, we'll see where that goes. All right, let's next thing, AI. AI, is it boom or bust? Right? We've seen a lot of these tech companies, right? NVIDIA really suffer a lot from these strong pullbacks. What are your thoughts, Julian? Do you think this is just the buying the dip situation, and we're going to see the rise in these big tech companies, or is this the end for the AI boom? What are your thoughts?
It's certainly going to change the world. It's just about when, how much time we have until that point, and in what way it's going to change the world. So, of course, it's going to make companies more efficient, right? Increased earnings per employee, right? Because everyone can be that much more efficient. But what does that do to those who don't necessarily fit into the corporate wheelhouse anymore, right? Like if you're a first year associate at a law firm, I think I've been reading at least that that's probably one of the first roles to just be replaced because a lot of it's research and writing. And if you can have a computer do that, much easier. Um, where you want to look, right? Of course, there's almost overvalued, overstated AI companies, but we've spoken about a lot that what these companies need is energy, right? So it's also good to invest in those types of companies as you look at it. And it's going to be a rude awakening for other companies. You take a look at Google. I'm not sure, Jackie, did you see what happened to them yesterday?
I did not. Didn't they t spend a ton of money on something that didn't work?
So effectively, in the last 5 days, they're down about 7%. And a big part of it is uncertainty over their future, right? Where 5 years ago, you would have argued they had the widest moat, right? No one was searching for anything without using Google, right? Who uses Bing? Bizarre. And so now, because of the artificial intelligence component, a lot of folks aren't even using Google, right? They're going right to ChatGPT or Grok or whatever it may be and saying, plan out my trip to the Caymans and, tell me what I should do, where should I snorkel, et cetera, instead of doing the research and Google getting the ad dollars. Now, Google has a very strong platform on Gemini, if you're familiar with as far as AI goes, but AI costs 10 times as much in power, in compute power. So it would be more expensive if Google were to seek to use that for more searches in some contexts. And then it's harder to monetize, where right now AI hasn't had a consistent monetization structure beyond just subscriptions. And will anyone pay a subscription to Google? I don't know. So there's a lot of questions around it. Whereas before it was argued, hey, this is the best thing since sliced bread. It's never going anywhere. To now, what's next? And that's a perfect example of where we at as far as AI. And even if you are right that AI is going to change the world, one of the strongest tech companies in the history of the world doesn't quite have a clear plan as to what's next, at least one that's public. What are your thoughts?
Yeah, I think it's one of those things where it's going to be hard to choose who the winner is because once upon a time it was only ChatGPT and it was like the clear winner. They're ahead. They rolled it out free. Everyone can go use it and toy around with it. And the gap is closing. Right? Like we saw that with like DeepSeek as well. And that really, speaking of energy companies, that actually took a lot of market cap from a lot of energy companies because DeepSeek came out and said, "Hey, we can do this and be more energy efficient." But just like they say the AI boom is like the gold rush, and just like in the gold rush, right, the actual gold rush, some people won, some people didn't, and when the gap starts to get closer like this, it's really hard to know who's going to be the winner. And it's also, some would say, perhaps the growth we've seen in the last 2 years might have been the boom, and we're not going to see that same growth maybe for the next 2 years because they're starting to level out and everyone is starting to, I think, get to the same space. But yeah, I personally don't think it's a bust yet. I just don't know if we're going to see those outsized returns over the next year or two that we saw in the past.
Yeah, and you still have to pick the right horse, right? Even if AI changes the world, which horse is it going to be? It's going to be ChatGPT, it's going to be Grok, it's going to be Gemini. There's a variety of platforms, and more than one will survive. But what happened to Yahoo? Nobody uses Yahoo, right? So even when you look at different searches and different things, who's going to win? And then even if you're right, and I can go on a couple tangents, even if you're right, what does that mean for the market performance? Is the company you're betting on overvalued versus future cash flows? I don't know if you remember, but in the 2016 election, the firm Jane Street bet on Trump to win, right? Which, if you at the time, huge underdog story. And so they said he's going to win and the market is going to tank. They were right about him winning, wrong about the market fluctuations. They lost something like $300 million. So even when you're right, AI is going to change the world. Are you correct on the market movement that will follow in the names that you hold? And fun fact, that was actually partially run by Sam Bankman-Fried, to my knowledge. So FTX,
Oh,
wow, full circle.
old man,
Um,
yeah.
yeah, but a lot of moving pieces, a lot of moving pieces. And so if there's one thing I know as of right now, it's that these companies require energy. Take a look at ExxonMobil,
Mm,
if you're going to bet on AI and a little bit more of a pure or less pure play, but nuanced play.
yeah. That's a good point. Yeah, Lily, yeah. What's the term? Speaking of gold rush, right? Bet on the shovels, right? Everyone's going to need a shovel to go mine for gold. But I'm gonna ask you the same question I've been asking Julian. Thinking of AI, if it's boom or bust, what does this do to one's portfolio? So you mentioned energy stocks, right? Which may be a good move, but should anyone be making any changes if someone wanted to capitalize on the growth? What would they do, assuming that they have a strong financial plan in place and they're working with the CFP and all that fun stuff?
So in our view, it's still that market agnostic approach. You know, you don't want to be playing catch up. Again, I've talked about it before, but usually when my father calls me about a stock, I know it's too late, right? I know it's run its course and it's easy to pick on him. But I think that's a lot of different people where by the time you hear about it or read about it in CNBC or Bloomberg, right, you potentially and likely miss the boat. So when you look at these names, you want to make sure that your portfolio is a ballast and you have things that are diversified where one portion is maybe higher risk in these AI names that rocket up, but then also rocket down in times of volatility. And with that, you want to own companies like Procter and Gamble, like Coca-Cola, that benefit from cash flows and that you can effectively reinvest over time. So there's a lot of nuance to it. What would you add? Because I know that's a boring answer, but boring works in my view and gets you from point A to point B.
Yeah, I mean, it's my philosophy, not just in investing in your financial plan, but really in life. The boring answer, unfortunately, is usually the right answer. We are big believers of just taking advantage of ETFs and index-based ETFs, and those vehicles are self-cleaning in a way, right? So a lot of families reached out to us when Nvidia was first making that run. And it's essentially a growth ETF, and it basically they're still buoyed by the growth of Nvidia without having to directly buy Nvidia and take on that, I say, more of a direct risk. So yeah, I can't disagree. And we invest market agnostic because you never know, right? I think some folks uh, sometimes get the recency bias because the last 2 years are so strong, you can almost basically throw a dart at the board and get a stock that will do well. But then when the things pull back, we never really know what part of the market's going to pull back. And if we told folks a year ago to be invested internationally, they'd be like, why? Because the domestic markets have been doing so well. And we don't have a crystal ball. I wish we did. But it's times like this, why, right? Where the balance has been a real balance for our portfolio. So, yeah, the boring answer is usually the right answer. Um, I don't disagree, obviously. But yeah, it's take advantage if you are someone, and this goes with anything. If it's cryptocurrency, anything speculative, it it should be small percentages, right? 1, 2% portfolio where if it goes to zero, it's not going to destroy your financial plan because some people are curious and they still want to, try to take advantage of something that might be a little bit more volatile. But it definitely should not be the core strategy. You definitely shouldn't be saying, hey, OMG, Nvidia's up, 50% this year. So I'm going to put everything in my portfolio with Nvidia, right? Because that's a recipe for disaster.
Do you know how much time the average person spends researching a stock before buying it, the average retail investor?
Um, Based on some retail investors I know, maybe an hour, maybe.
6 minutes.
Wow.
So quick, probably a quick Google search. You know, maybe they're looking at price action, whatever they think that means, and Googling, NVIDIA stock and just looking at the chart. So 6 minutes goes by fast. Not doing all that much research, and even if you are, do you have more data, more information than Citadel? Probably not. So usually best not to bet the house on something speculative.
Good points. Good points. Awesome. Well, nothing else here to talk about. I wanted to keep this brief. Well, thank you all for listening. If you have any questions for us, please don't hesitate to reach out. But I'm Jackie P, and this is Julian. And yeah, thanks for listening. Inevitable Wealth.
Thanks for joining. Have a good one.